thanks everyone who's joined so far. Really great to have you here tonight. For those that don't know me, I'm Richard Williams. I work for Broadgate Search. I'll be hosting the evening alongside our panel. So I just want to start off just a little bit of housekeeping before we start. If I could just ask everyone to refrain from putting their cameras on, and if everyone could just put themselves on mute throughout, that'd be really good. I really look forward to seeing as many of your faces as I can during the networking session afterwards. And like I say, there's a lot of faces that I've not seen for a long time now. So really looking forward to seeing you. You will see on the screen, there is a Q&A section. Now I'd really encourage anyone that's got any questions, to put them on there throughout the session. We'll pick as many of these up as we can during the evening. Following the event, we will also be putting together a white paper. So anything that we don't get a chance to answer, please do keep those questions coming through. We can really make sure that we're answering as much as we can for you. We'll also be doing a couple of polls throughout the session, sporadically. So we'd love to get your interaction on those. Love to hear your kind of feedback, and like I say, see how things develop, throughout the session. I know we've got people that are attending from across the UK. I think we've got Dublin. We've also got some people joining from the US here tonight. So really appreciate your involvement. Thanks for supporting these. This is the latest edition of our Broadgate Search Social. So I know there's lots of familiar names out there who have seen sign up, but for those who I'm yet to meet and those who don't know me, really looking forward to speaking to you in the networking afterwards. Again, I look after the UK risk business for Broadgate Search. Been with the business for 3 years, and a big part of what we do is this offline and online community, which we're all part of. So yeah, again, thanks for attending. We've run this event in partnership with our really good friends and partners, Lucky and Camille from Cube Risk, who've been instrumental in helping to put it together. And I'd also just like to take the chance to thank our panelists for giving up their time throughout the organisation of the evening and tonight. We really do appreciate it, and obviously we couldn't do it without you. So look, in a few minutes, I'm going to introduce you to them all, the panelists, just so you can get to know them a little bit before we start. But I just wanted to take a couple of minutes, really, and just kind of look at, why do we put on these events? So, as well as Broadgate Search being a governance recruitment business, a big part of what we do is to bring the risk community together in the form of our online, offline events. We've done webinars, podcast series, white papers, and I think you'll probably agree, like in the current climate, it's just more important than ever to find different ways to help stay engaged. And I'm sure we all desperately miss the chance to network with our peers in the ways that we'd like to. And, hopefully we can get back to doing that, face to face in the very near future. This will be our 12th Broadgate Search Social. It's the 5th webinar that we've done. Throughout the series, we've looked at topics of emerging risks, various D&I topics. Most recently, we've covered IR35 regulations, which I know there's quite a few of you who attended. And we're always looking to do our next one. So if anyone's got any ideas or would like to get involved for future events, please do kind of make yourself known. We'd love to hear your thoughts on that. I look back to, the last event on the 5th of March that we were able to do in person, and the event focused on operational resilience, which at the time was very topical, but perhaps didn't realise quite how quickly some of those things that we learnt the night would be implemented and tested over the last 12 months. We really do try and make these informative, beneficial, and like I say, really keen to hear your thoughts on next events. So I think from speaking to a lot of you over the last 6 months, climate risk has been a topic on all of your radars. Perhaps we haven't known exactly why, which is why we were so keen to do this one. And whilst we'll try our absolute best to cover what we can within the hour, I really do urge everyone to stay behind, if at all possible, for the networking. The panel will be making themselves available in the breakout rooms to answer as many of your questions as they can. But as I mentioned, rest assured, we'll be producing a white paper off the back of the evening. So anything we don't cover, any afterthoughts that you might have, please let us know. we'll certainly try and get them covered as much as we can. So, I mean, climate risk, I think we've all seen enough in the press and the TV to know that climate risk is almost certainly the biggest risk of ours and also the next generations. And we all want to make sure that we can do our part to help future-proof the planet for generations to come. We've got governments pulling together with the Paris Agreement, where we're all working towards the same goal of net zero by 2050. But, me personally, and as individuals and as businesses, do we really truly understand what this means in terms of how we change our behaviors? How does this impact us in our work and our careers? And, whilst 2050 might seem a long way off, especially in terms of our professional life, we all know that the regulator doesn't look this far ahead. So the questions we all need to think about are, what should we be doing here and now to make an impact? Why is it so important to act now? And more dangerously, what is the impact of not doing anything at all? So look, that's enough from me. I think it's time to introduce you to the panelists. So Lucky, I'm going to start with you. If you could just let us know name, your role in the organisation, and if you happen to have one, as a bit of fun, and hopefully not to embarrass any of you too much, if you could maybe just let us know maybe a hobby or interest that you've taken up since the beginning of the first lockdown, just to help pass some of that time.
Awesome. So thanks, Richard. And firstly, thanks for having us. And it's a pleasure to be co-hosting. I think climate change is incredibly important, and it's something that I am personally sort of passionate about, and I've been obsessing over over the last year or so. And it's not just from a financial point of view, but also from a socio-economic perspective. I think there's huge impacts that we need to act on now. So I'm really glad to be speaking on this panel with everyone. So thanks for helping to put it together. And my perspective will be coming from both the banking and practitioner perspective. So I worked previously in the likes of HSBC, Accenture, Lloyds, some of the biggest banks in the world and internationally. And since then gone on to found my own consulting firm alongside Camille. And we specialize in credit risk. So this is an area that we understand inherently in terms of the risk governance frameworks and how you embed it in things like stress testing, scenario analysis, and so on. But at the same time, I'm also building a solution against it, right? So it's not just all talk, it's about how do we help banks grapple with data and analytics. So another company that I founded, which is also something I'm assessing over, is Climate X, and that's where we're really building the technology that's needed in order to act upon the real physical and transition risks, and we'll get into that later. In terms of the most interesting hobby or what I've been up to over the last 12 months during lockdown, I've taken it as a convenient excuse to get my head down and work and build my own businesses. So I've been in a position where I've been super hyper productive, and it's been quite an amazing journey, I think. And in the blog interview that I put up a week ago, I went into more details there, but yeah, I've just taken my whole life into a different direction. So it's been a cool 12 months, and no signs of slowing up. So
yeah, cool. Excellent. Yeah, cheers for that, Lucky. And David, if I could pass across to yourself.
Yeah, thanks, Richard. So I'm Dave Stainforth. I'm a professorial research fellow at the Grantham Research Institute for Climate Change and the Environment at the London School of Economics. And I'm also a visiting professor in the Department of Physics at Warwick University. And I'm interested in how we go about evaluating risks and probabilities in the context of climate change, and in particular climate predictions. I'm a physicist and climate modeler by training and experience, but nowadays I work on everything from mathematics and nonlinear systems to climate policy, adaptation planning, economics, and even a bit of philosophy, which is always quite fun. And I'm afraid I'm quite lucky. Sort of, I'm trying to write a book. I'm committed to write a book, and so the time during lockdown has been, well, okay, I need to get my head down and write this book so that I can enjoy myself after it's over.
Yeah, absolutely. And I see you've been traveling in the mountains at the moment, David. So
that's a couple of years ago.
And Maxine, if I could pass across to you.
Thank you for that. It's great to be on the panel. I'm Maxine Nelson. I'm a Senior Vice President at the Garp Risk Institute, which is Garp's research and thought leadership arm. In case you haven't heard of Garp, it's the Global Association of Risk Professionals, and we're a membership-based organisation, and we educate people in financial risk management and also sustainability and climate risk. Now, prior to joining Garp, I've worked in lots of different risk areas in banking: operational risk, retail, wholesale credit. I was responsible for counterparty credit risk at the UK FSA in the last crisis. I've been responsible for capital planning, and also have a background in mechanical engineering. And climate risk is quite scary because it's such an all-encompassing topic that having worked in so many different areas is really, really helpful to understand the impacts of it, because it's impacting on all the different risk types and all the different industries. Something interesting that I've done in lockdown, in the last November lockdown, I decided to take a photo a day. And I could do that because that lockdown went for about 30 days. So I met that challenge. But at the start of this one, I thought I might do the same thing, but I think it's just too long. So I haven't managed to do it for this lockdown.
Yeah, that might be a never-ending album. I think I just started that a year ago, but no, that's a really good one to take on. And Justin, if I could pass across to you.
Sure. Hi, Richard. Hi, everybody. My name's Justin Elks, and I'm a managing director at Crow UK Consultancy, where I look after ERM, resilience, and increasingly focus on ESG and climate matters, really kind of focusing in on the insurance and asset management industry. I'm not a lifetime consultant. Before that, I was a CRO and risk director in industry. And I suppose my most interesting activity and hobby in lockdown, I've always done a lot of music, but over the Christmas period, I rebuilt a small music studio in my house, and I've started doing songwriting. And my ambition for this year is to write one good song this year. Easy to write a song, difficult to write a good one.
Excellent. Well, perhaps next time you're on a panel, Justin, we can have that as the intro. We'll look forward to that.
Yeah, seems like a really bad idea to me, Richard.
And last but certainly not least, yeah, could I introduce John?
There we go. Good evening, everybody. John Scott from the Zurich Insurance Group. I'm head of sustainability risk at Zurich. For the last 10 years, I've been chief risk officer of our commercial insurance business, and took on this new role about 2 years ago. A long time ago, I was a geoscientist, so I've got something in common with David. I understand how the planet operates and stores and releases carbon quite well over geological time, and can put the risk that we face today into some kind of time context, and obviously in a risk context, which is obviously the purpose of this call. So, small fact about me related to the last year, I spent rather a lot of time with the World Economic Forum writing a COVID risk report back in the first lockdown, and just recently we've just published the Global Risk Report 2021, which has got plenty of good risk stuff in there. So feel free to download and have a look at that. Looking forward to the meeting.
Yeah, excellent. No, and thanks for joining tonight, John. Really appreciate it. So, look, thanks to all the panel. So, guys, as I mentioned just before, so during the course of the evening, we are going to run a couple of polls, and I'd like to start off by launching the first one. And this will be interesting to find out your thoughts. I think, especially given the knowledge that people have at the moment, we really just want to look at your personal understanding of, how important is it for your career that you understand how climate risk impacts your firm? And we'd love to find out your take on this, and perhaps we could ask the same question towards the back end of this and see how the answers differ. But if everyone could please, that should show on the screen now, just place their vote, that would be great. Okay, wow. So thanks everyone for voting on that. I think it's a pretty overwhelming majority, which is good. So look, I mean, 84% of people coming back saying that it's important to understand how climate risk impacts their firm. I certainly think, had we have run this 12 months ago, it would have been a very different story. And I would expect if we did it in 12 months' time, we'd even be pushing towards, 100%. So really interesting, to do that. And thanks very much. So we'll follow that with a couple of other polls throughout the evening. So look, I want to start off by asking David, from the world of science, David. So look, we've all seen that the government are aiming for net zero emissions by 2050. It's 29 years away, but why is it so important to act right now?
Okay, thanks, Richard. Let me share my screen. Let's see, okay. So I guess my role here is to set the climate scene, and I think there's really two main messages that I would like to put across in my kind of 5 minutes. And one is simply that the risks associated with physical climate, that's so floods, heat waves, droughts, the risks, the supply chain risks due to storms and disruptions of that nature, all these risks due to physical climate, they have changed, and they are changing, and they will continue to change. They're not the same as they were 100 years ago or 30 years ago or even 10 years ago. So if you're assessing your risks based on looking at historic details, you're going to be wrong as to what they are today. And you're going to be even more wrong, vastly more wrong, as to how they are tomorrow. So that's going to be my first couple of slides in a moment. But then the other side of this is that just because we know they've changed doesn't mean that we know what they are or exactly how they've changed. This idea of making climate predictions, of assessing climate risks in the future, is really at the cutting edge of science. It's a cutting edge of knowledge. We don't know how to do it. And so we're trying lots of different ways. And that means there's a real need for business and academia to work closely together to separate what we know from what we don't know and how to use it. But coming back to the first point, here's a plot of the carbon dioxide levels in the atmosphere over the last 650,000 years. And as you can see, over that period, you've got some ups and downs, you've got ice ages, you've got interglacials, but throughout that period, the values of carbon dioxide in the atmosphere have been between 180 parts per million and essentially 280 parts per million. That was until the Industrial Revolution, until 1750 till today. We've had a rapid increase, increasingly rapid increase, and at the moment we're above 410 parts per million. If you include other greenhouse gases, nitrous oxide, methane, then we're at the equivalent of 470 parts per million. This is huge. We're talking about a change, but not a small change, a huge change. And why does that matter? It matters because greenhouse gases trap energy in the lower atmosphere, and that's going to lead to heating, and it's going to lead to disruption. It can't do anything else. It's basic physics. And so that's what we see. The plot on the left here just shows changing global mean temperatures over the last 170 years. Each of the last 3 decades has been warmer than the last, and warmer than any other decade since 1850. And we see all sorts of other changes. We see increase in sea level. Sea level is a great indicator of climate change because it integrates the warming as the heat flows into the ocean and leads to water expansion. But there are other changes. There are ocean acidification leading to changes in ocean ecosystems. There's an intensification of the hydrological cycle. There's more energy in the system, so there's more extreme events. All these changes are happening and we can register them. We can see these things are changing. So everything fits together. And all of this is basic physics. It's what we expect, it's what we see. So should you be concerned about climate change and the impact on society and business? Absolutely yes, no doubt about it. Predicting warming and climate disruption is easy. The problem is predicting the details. The details are difficult. What is going to happen in Milton Keynes? What's going to happen to flood risk in Bangalore? What's going to happen to storm risk in Miami? The details are really difficult. And people tend to go, academics included, tend to go for the models. We've now got big computers, we've got big models, and we run them. And they provide lots of detail. And indeed, you can get your risks out of those models. The problem is they're risks within the model. The models are different from reality, and we're really struggling at the moment. How do you relate your models to reality? This plot here is a time series of global mean temperature from 1900 to 2010. The black line is observations. All the other lines are different climate models. They all show warming since 1970. Of course they do. You put in extra heat in the system. It can't do otherwise. But the range of different absolute temperatures is about 3 degrees. They have a different temperature by about 3 degrees. Now that's a problem because we're trying to predict a change of about 2 degrees. If the models are wrong by 1.5 degrees, that means the snow line's in the wrong place, the tree line's in the wrong place, the ecosystem's in the wrong place. It means you can't trust the details. You might be able to trust the details at the global level, possibly at the continental level, but you can't trust them at the level of Oxford or the level of New York, and that's a problem. So we've got a real issue. How do we identify what we know and what we don't know? And then I want to show one last thing, which is slightly different, but I think perhaps relevant. There's been a lot of effort to evaluate the economic costs of climate change. There's a lot of debate in that area. We know them to be high, but we don't quite know what they are. But the arguments there are that we want to know the costs. We know if we mitigate, reduce emissions, then we will bring those costs down. That's the idea of it. This is a little piece of work that I did with colleagues in Georgetown and Warwick recently, which says not what are the costs of climate change, the average climate change, but what are the costs of variability of climate within a climate change scenario. There's lots of variability in climate, and as we get into a warmer world, the economic impacts of that variability become greater. And the assessment here is that the costs of that are between $9 trillion and $46 trillion in today's money. That's an awful lot of money. And the crucial factor here is that's not something that can be avoided by mitigation. This needs to be dealt with by increasing resilience, adapting our systems. And that's where business managers, insurers become really important. These things cannot be got around just by mitigating. And that was my last point. Thanks very much.
Well, thanks ever so much, David. I mean, that's really thought-provoking and quite scary stuff when you look at it. And but I think, you know, if we move across Maxine and Justin, if perhaps I could leave this point with you, but, you know, following this, what is this? What's going to be the impact on financial services from your perspective?
Yeah, now as David's pointed out, climate change has really far-reaching impacts. So it's going to affect all geographies, all industries, and all companies. And regulators require financial institutions to understand the risks they're exposed to. So they have a lot of work to do to understand all of those global impacts. Now, from 2015, the year the Paris Agreement was signed, we've seen more and more involvement from regulators. So, for example, from the French mandating climate disclosure, China put green finance on the Financial Stability Board agenda, to more recent statements from the PRA, the ECB, and even more recently from the US regulators. And also from other regulators collectively through initiatives such as the NGFS, the Network for Greening the Financial System. And the sort of things that the regulators are looking for is good governance and accountability for climate-related risks. And actually, they're even starting to broaden that out to environmental risks more broadly. And they want to see climate risk embedded into day-to-day risk management. For example, establish targets, limits, metrics, work out how to actually measure this. And they want to see more development of tools such as scenario analysis to understand what the exposure to climate change could be in the future. Now, if the regulators push companies to better understand their risks, they will help progress. But if they move too fast and climate risk management turns into a regulatory compliance exercise, then progress could be hindered. So there is a balance here between regulatory pressure to get financial institutions to look at this difficult topic and not too much pressure that it just becomes a tick box exercise. And if we look at another dimension, so scenario analysis is an important tool to understand the impacts of climate change because of the long-term nature of them. And we saw when stress testing was introduced about a decade or so ago just after the last crisis, that there was quite a big divergence of regulatory approaches. And firms are concerned that this divergence will increase with the climate-related stress tests, and that learning the intricacies and the details of so many different stress testing regimes won't actually help them to manage their portfolios better, nor will it help with a joined-up approach to managing this truly global risk. Now, Garp held a climate risk symposium in November, and we had a panel of regulators and practitioners, and they were asked this question. And the regulators responded that working through the Network for Greening the Financial System, they aim to have a joined up approach. However, the practitioners weren't yet convinced, but they hope that this means that they won't have to implement a lot of different approaches so that this really can be tackled a bit more holistically. Now, capital is also a question that normally comes to mind straight away for banks. And the use of capital for climate risk is a really good question. So we know that capital is held as a mitigant against risks. So therefore, insofar as climate risk affects credit risk, market risk, operational risk, then capital should be held for it. But we need to make sure that green isn't confused with, for example, lower credit risk. Now, you could say that brown is associated with increased transition risk, so therefore it is associated with a higher credit risk. But green doesn't necessarily mean lower credit risk. You still need to make sure the company has a good business model. Now, at the moment, taxonomies have been normally designed to separate green from brown, but it remains how helpful they will be for actually assessing the risk of those companies or those transactions. However, if given firms are required to hold capital for risks that they have identified, they now would probably be looking at holding it in Pillar 2. And then it would also could be identified as a specific piece of capital for climate risk. And over time, how to assess that will be evolved and refined. And the last thing I'm going to touch on is disclosures. It's another big topic, and we're seeing more governments, the UK amongst them, mandating disclosures. And we need to be really careful that disclosures are comparable and that the information contained in them is useful in order for this to be a good thing. Otherwise, it's just one more piece of paperwork, some more information that's being created, creating cottage industries, which isn't actually helping us to understand and manage this problem.
Excellent. Thanks ever so much for that, Maxine. That's really interesting to know. And Justin, could I pass the same question across to yourself?
Yeah, absolutely. So I think, thank you, Maxine. That was a really good summary of the regulatory territory. And I think probably just to add to that, it'd probably be helpful for me just to sort of touch on what I see the drivers behind financial services focusing on climate change, and particularly the board, and then perhaps spend a bit of time thinking about the risk function, what they're doing, how they can help, and what that glorious phrase embedding approaches to managing climate related financial risks by the end of 2021 might mean. Boards coming under increasing pressure at the moment from a large number of stakeholders. Investors are increasingly seeing ESG performance and climate as a potential differentiator, and that's being reflected in ESG ratings. We're also seeing concern from boards about employees increasingly wanting to work for companies who have a social purpose. Customers also are seeking more sustainable, ethical products, and are really, I think, post-pandemic starting to focus on using companies they can trust. And finally, as Maxine said, regulatory engagement is massively increasing. And board engagement on the topic has been quite interesting to me. I think we've seen something of a shift over the last 12 months. We run Ned Club events and quite often have ESG and climate on the agenda. And if you sort of dial it back around about the time of the pandemic really hitting in the UK, I think there was a real split view in the boardroom. Some directors really seeing ESG as an area where politicians need to act first. When the pandemic hit, I think there were some boards that had the mindset of sorting the economics out first, and then once those are sorted, addressing climate change. But you know, to be fair, some, however, were very much seeing climate change as part of how businesses build back better after the pandemic. I think if you fast forward to today, I think you're now seeing much more engagement from the board on this topic and a real desire to push forward. One of our members of our Ned Club said earlier this week that discussions have shifted in the boardroom from why and what to how, which I personally think is really positive. I think COVID-19 has helped with that, I think, by increasing society's focus on resilience and longer term thinking, and having to deal with those difficult interconnected issues that David was kind of outlining. I think the pandemic has also helped to give people confidence that companies can make major changes in their operating models quickly when they have to. I think it's fair to say there's a good dose of realism in board 2. Tackling climate change is a huge task requiring innovation and financing, and a global problem where global political will is needed. But my sense now is that boards are increasingly stepping up and not using those problems as an excuse for inaction. So that's kind of interesting then to think about how risk functions can help. And I think for me, there are probably 3 broad areas they can help. I think risk functions can help to facilitate change and provide leadership. Climate and sustainability is a difficult area involving many parts of a financial services business, and risk functions are really well positioned to bring a long-term view to that, to bring wider external perspectives, and also to help organizations to focus on making climate change and tackling climate change a priority, helping them make sure their response is authentic, that it's focused on areas where the organization can make the most difference and isn't just PR and greenwashing. We've seen a number of CROs and risk people start to take the lead on these areas. So take a bow, Mr. John Scott, at this point. And if not taking the lead themselves, I think they can help to clarify accountability across the lines of defence and to ensure that governance is effectively considering it. Education and awareness is also important here too, helping people to understand the risks, but also the opportunities in climate. And this is key to ensure the business is able to develop and embed its own strategy in respect of tackling climate change, closely connected to its business strategy. And we see that as really the first key step that we think organizations need to take to step up in this area. Second area is enhancing the enterprise risk management framework. And I think Maxine covered the territory really well here. So I'm only going to make a couple of additional points around things we see. As well as things like scenario analysis and process and policies, we're also seeing organizations looking at their risk language and their taxonomy and thinking about how that brings climate change to the fore. And we're also seeing companies increasingly looking at their risk appetite and preferences to think about where it will be valuable to set targeted risk preferences or adjust existing limits and thresholds, and clearly thinking about how risks can be reported to boards, basically giving the board a view on progress, making sure it has the right focus, given the targets, given any organizational commitments that have been made, and also the risk profile. But more important than all that, I think, is the third area, which I think is promoting focused action to address climate change. The risk framework is fine and it provides the basic building blocks. But the proof of the pudding here is the risk framework impacting on the business decisions made. The sort of point about risk management isn't just to assess risks for their own sake. It's to bring to mind uncertainty and start doing something about it. Now, what makes climate change obviously more difficult is how to convince people to take action now on a risk that can be seen as manifesting itself on the company in 30 years' time, particularly where, for example, you have investors that are traditionally thought to have a pretty short time horizon. I think risk can help in this as well, in making sure the focus is across the time horizon on the short, the medium, and the long term, and helping to think through interim steps and transition states. So I think those are the 3 areas I see. I'd just like to touch briefly on what this whole embedding by end of 2021 might mean. It certainly makes people very nervous, and I think certainly risk people have struggled in the past where regulators use embedding, quite often applying it to a short time period, whereas risk people, I think, instinctively know that embedding is often a multi-year activity. But from discussions that we've had with regulators on climate change, I think the overriding things that we see regulators wanting companies to do is around being proactive and doing the right thing. So, for example, I think the PRA deliberately haven't specified guidance around what they mean because I don't think they're clear what effective looks like yet, and they're keen to have a dialogue with the business world around what that looks like. And I think what that means is they want companies to focus less on what they have to do because the regulators tell them, and more on what companies think they should do. And so I think they'll be challenging firms on whether they're really seeking to make a difference or simply greenwashing. I think another interesting point is I think they see companies making progress both on managing the risks of climate change, but also on the disclosures by looking at it iteratively, by making a start and refining things based on their experience rather than waiting for detailed rules or an absolutely perfect answer on these things. So I think if we're looking at embedding by that point, I think regulators will be very comfortable with a position where the key building blocks are in place, where the organization can give good examples where they've started to make a difference and where there's a clear plan and commitment to continue with that. I think they're also more likely to support approaches where they're focused and based on those areas where companies can make a difference. I think that'll also help to make companies to realize the benefits from what they do, but also avoid the appearance of greenwashing. Okay, back to you, Richard.
Yeah, great. Yeah, thanks for that, Justin. Yeah, all really good points. And I think you touched on a couple of things. I think, companies have certainly got a strong appetite to make change, regardless of regulatory drivers. I think there are, sufficient factors that enable them to want to make the change. I think over the last 12 months, we've certainly seen that people have the ability to be agile and make significant changes. But Lucky, perhaps John, if I can ask you, how are we going to monitor these changes, and what challenges is that likely to bring?
So yeah, I think monitoring is going to be really complex initially for a lot of people because it's new types of data that I think people haven't dealt with before. So even the curve of understanding what it means, as David alluded to at the start, that in itself will be a journey that people will need to go into and invest heavily, I think. But in terms of just even data itself is a challenge. And Maxine also alluded to standardization, right? So where do you get your data from in the first place? What are the types of things that you want to monitor? You start with the foundations, and I think these are the questions that need to be answered. There are going to be some cases where you get guidance around that. So I know CFRF and regulators are working to provide standards. There are some indications from things like TCFD that point to places that you can look, but fundamentally the substance is what matters. So the outcomes, I think, in terms of what you want to do with that data and what you conclude will ultimately trace back, and I think straight to the climate projections in the first place. And I think it's important to remember that even at that level, when things are done differently, so if you take data from different suppliers, and some of them are using one type of climate model and others using another, you quickly end up with an inconsistency at that very starting point, which means by virtue of that fact, your outputs are going to be different. But then as you extrapolate that inconsistency out over time, then things continue to compound. So I think benchmarking your suppliers or benchmarking your sources where you get data and the results that you're receiving is going to be really important to make sure that you got some sort of credibility in terms of what it is that you're concluding from these climate assessments. Another step I think in terms of monitoring is just about the data capture process at origination. So when you're lending to a new counterparty, a new business, if in the wholesale credit risk world, have you assessed, for example, what the impacts of climate change and the carbon zero economy mean for that business, and how do you quantify that in terms of some sort of risk score, for example? And these are things that you can capture right now, and I think a lot of firms have already started to do that, and there are some that are yet to embed those kind of measures as part of the scorecarding process. And then ongoing scenario analysis. So I think everyone's used to running ICAP, they're used to running stress tests, and now we're seeing the introduction of stress tests and specifically focused on scenario analysis. And we'll see, I think that's going to tease out a number of different vulnerabilities maybe that people haven't explored before, or they might manifest it in different ways because of past events, right, that have triggered action to deep dive into specific parts of the portfolio. Within the scenario space, that lends itself to questions. So where should you go for scenarios? I think the NGFS have been super helpful with providing reference scenarios that are available, and people can start using them if they haven't already. And that deep dives into 3 key ones. You have an orderly scenario where the country and the planet basically moves to a net zero carbon economy by 2050, and they do so with the right policy actions and measures early on. So we start the march today. And then you've got disorderly scenarios where people eventually get there, but it's more of a knee-jerk reaction and that drives up the cost of transition risk. And then you've got the whole scenario where we just, carry on as we are, and you end up in this hothouse world, as they refer to it, where you miss the climate goals, and physical risks will dominate, but also I think that'll lead to certain types of transition risk. So the stocks and also I think for benchmarking might not always be appropriate for firms, and I think this creates complexity in terms of that benchmarking process and how do you monitor, because actually your portfolio might not be particularly tested by a scenario that's been put out by the NGFS or by a regulator, because they might be considering a specific theme, right? And so I think it's important that people recognize that there is a place, nevertheless, for custom scenario analysis. And I've seen some really good work in the TCFD, for example, disclosures of some firms of late where they've done just that. And then in terms of the actual climate assessments and what you want to monitor, you've got the physical risks, as David mentioned at the start. So floods, storms, subsidence, I think those are the things that will really be prominent and prevalent in the UK, as well as extreme cold and heat. And these things are things that will physically damage your assets, your property, your infrastructure. And you would ultimately want to feed that into your LGD models, your loss given default models, because that will have a direct correlation to your impairment and provision line. And then you've also got, in addition to that, the transition risks, which I don't think we've really touched on yet. And so the transition risk is the cost of moving the economy or your business, if that's what you are, or it could even be individuals in the retail book, to net zero. And so that's often tied with things like, carbon offsetting. There's a cost attached to that for most firms, moving to renewable energy sources. And I think if you're on the extreme end of the scale, you might even have to pivot your entire business model. And there's going to be physical costs attached to that. And these types of things will impact cash flow. And those cash flows then, combined with everything else that's going on, might well lead to an increased probability of default. And I think the transition risk side will start to see manifest a lot sooner than the physical risks in the real world, right? Though I think it's important to recognize that even though the physical risks are out there in the decades to come, the impacts of those pricing changes will start to be realized a lot sooner than people perhaps would like to think. And then deep dives into data. So I guess is the common sense approach of does this data make sense? Like, based on the scenario that it's seeing, do the outcomes, are they tangibly making sense to the person that's using it in terms of the context of the portfolio? The level of the monitoring that they put in place, I think, is going to have to be repeatable exercises, testable exercises, looking at the external environment for the benchmarks, because actually we don't have many in the banking space right now. So are there the places that you can go to find an understanding of what you should expect? And, I think John can definitely comment on it more, but insurers generally are ahead of the curve a few steps, before the banking industry, and there may be some cross-pollination in terms of learning. And so I think for me, though, bringing this back full circle, monitoring is great, but what really matters here is the action that's taken off the back of it, right? So this can't be seen as a tick box exercise where you just fill out some forms, fill in some unstructured data requests for the PRA, and then you file things away for 12 months. Because whether people like it or not, the wave is the ocean is moving, right? And the way that I kind of look at this is put the monitoring in place so that you can either pedal to the shore, or the wave is going to crash you into the rock, right? And the question is, which one of these types of people and organizations do you want to be? So monitoring is great. Think about what the outcomes are. What are you monitoring for? What is the end goal? And then how does it help you move in that direction and take actual actions to strengthen your business?
Excellent. Thanks ever so much for that, Lucky. John, could I ask the same question to you? And got a follow on from Lucky. That'd be great to hear your thoughts.
Sure, and Lucky's right to highlight the issues with data, but there's some other challenges as well in trying to understand climate risk. So climate risk turns out to be a very different type of risk from many other global risks that we face. You think of massive cyber attack or weapons of mass destruction or the current pandemic crisis. These are things that are events that happen. You think back to the global financial crisis in 2008, it was an event. The problem with climate risk is it happens slowly over a long time. And there's something very typical of human beings, that our response developed through our long evolution is one of adrenaline and fight or flight. So this is the classic frog in the boiling water issue. and we need to act. And I think the message from David's a very strong one, and the message from the IPCC scientists, especially with the 1.5 degree report back in 2019, that we really need to act fast in the next decade to halve emissions globally if we're going to achieve the Paris Agreement goals of a substantially lower than 2-degree warming world by 2050. So I think that brings the sort of timescale forward a little bit, even if some of the physical risks of that lack of mitigation will play out over not just decades, but centuries and even millennia. So we know that from the geological history, we know how these things play out. And so in the financial risk world, and this is different for every different type of financial business, whether you're a bank concerned mainly with credit risk, whether you're an asset manager concerned with other types of risks, liquidity risks and diversification risks in your portfolio, or whether you're an asset owner, whether you're a pension fund, or whether you're an insurer, and that will change whether you're a general insurer or a mixed life and general insurer, or whether you're largely a pension or life insurer. You're all going to have slightly different risks to be concerned about. I just want to quickly touch, because you asked about monitoring there. Depending on those different types of risks, sure, if you've got a credit book, like Lucky was saying, in the banking sector, that you could have impacts on that quite quickly with the transition risks. And perhaps some of the physical risks as well, if you think about loan book on an asset-based mortgage book, for example, in a flood-prone area. And we already see that in places like Florida, for example, which are already subject to flooding, and it's quite difficult to understand. Well, it's quite difficult to understand how people can finance new building in flood-prone areas when the floods are obviously going to impair those assets. So I think in the past, the banking industry has always thought, oh, well, that risk is offset by insurance. But the reality is the insurers aren't charities. We're not going to be, well, it makes no commercial sense to use the risk transfer mechanism of insurance to insure somewhere that's flooded so regularly. I mean, there's no point in giving someone some money for a premium if that premium is just going to be handed back literally, it's a dollar swapping exercise that handed back almost straight away to manage a claim. So that doesn't work. You're not managing the risks of the few amongst the many then. That's a truly systemic risk that needs to be managed in a different way through public-private financing and government policy and regulation about where people are allowed to build. And if people insist on living in a flood-prone area, well, that's fine, but don't expect everyone else to pay for you. So I think that's quite important. Just while we're on physical risks, I think the insurance industry has got a huge amount of expertise in understanding natural catastrophe modeling. It's very important for us because for property insurance globally, especially for the major natural catastrophes or the major peril regions like Gulf Coast hurricane or Western US wildfire or Australian wildfire or Northwest European windstorm, these are the kind of things we model. The Nat Cat models are calibrated pretty much on an annual basis. And it's an inconvenient truth, but when we look for climate change effects, other than the obvious ones like land ice melt and consequent sea level rise, and actually, when we look at the Nat Cat peril regions, apart from prolonged periods of heat and cold, the more chaotic weather systems are very much more influenced by the multi-decadal systems like La Nina, El Nino, or the Southern Indian Ocean dipole, rather than climate change effects. And even if you try and stress the Nat Cat models with the most extreme changes in ocean surface temperatures, for example, you don't get much difference or much change over a 10 or 20-year period of these perils. That's not to say we shouldn't be concerned, because once we reach these tipping points, as the Earth warms and the Earth starts emitting more carbon, I mean, I think there's a really good report I encourage you all to look at, which is from the CRO Forum, which is called The Heat is On, that was produced a couple of years ago. And that's something we should all be concerned about. So what I'm not saying is that whilst these changes are long-term, we must act now to deal with them. So just coming back to the point about, or the question about monitoring, I think one of the things we can all do in our portfolios is monitor something very straightforward. And David mentioned it. It's the carbon that's in the atmosphere. and our contribution or the finance contributions of that carbon in the atmosphere. So again, the CRO Forum did some work, which I had the pleasure to chair last year or the year before, and we published it in early 2020, which was essentially a methodology for carbon footprinting of underwriting portfolios. There's been a methodology for underwriting in asset portfolios for quite a long time, but this is for underwriting portfolios. Very much more complicated because there's lots of double counting involved with reinsurance contracts and just the structure of the way insurance works, and across different lines of business and different geographies and different sectors. But monitoring something as straightforward as that and linking that to an overarching purpose in your organizational goal, like, for example, committing to the UN Global Compact 1.5 degree commitment, which Zurich has done we were the first insurer to do that. We did that in the middle of 2019. And then working as an asset manager or an asset owner through organizations like the UN convened Net Zero Asset Owners Alliance to engage with people and organizations in the real economy. These are the people who are generating carbon emissions, not the finance sector. We have an influence over them, but in some cases it's quite tenuous. But what we've got to figure out is how to engage and support those companies in their transitions and to help manage those risks of transition. As I say, in the carbon intensive sectors, which provide vital services for every economy around the world, whether that's energy, whether that's transportation, not just of people, but of supply chains of goods, for the vital components of infrastructure, iron and glass, iron and steel, glass, cement, agrochemicals, petrochemicals, and agriculture more broadly. We still have to feed nearly 8 billion people on the planet. All these sectors have to change, and they have to change dramatically in the next decade, and certainly by the next 30 years. So I think whatever metrics we put in place as financial services companies, banks, asset managers, asset owners, or insurers has to reflect that reality.
Great, thanks ever so much for that, John. And I think, we'll forget climate risk is obviously going to be a huge regulatory driver over the next couple of years, but profits. Companies, as much as they're going to invest in this, they are still there to turn a profit. So it's about, investing wisely and, like I say, servicing their customers in the best way that they can. So something I'd just like to cut to our second poll for the evening, if I can, just off the back of the answers that we've just taken there. So we're keen to see within this about, what climate risk is your firm most exposed to, from physical to transition. If you could place your kind of answers on the next one. I think we've just had the first poll put up there again. We'll just try and change that. There we go. So if you could just tick what climate risk is your firm most exposed to. And we'll just leave that up there for 30 seconds or so. Okay, so I have to say, a much more even spread there, and certainly from my side, I would have fallen into the last category on there of not sure. I think that's where a lot of people are at the moment. I think for the slightly more climate risk educated individuals amongst us, the physical and transition risks are certainly kind of making headway amongst those. But again, it'd be really interesting to perhaps ask this same question again in 6 months or 12 months time and see what people's knowledge around it is and actually where they see this sitting. So thank you ever so much for casting that. Again, we can go into a bit more depth within our white paper about answering some questions around that for you. So just leading off from the last question, and I'd like to put this one across to Lucky. And again, if I could ask John again, what are the regulators expecting to see from the market in terms of, how we're monitoring performance, and how do we monitor improvements that we're making to justify all of these investments that we're likely to have to make. Lucky, if I could start with you, that'd be great.
Yeah, I think it's an interesting point, like just what you said about justifying the investments. Ultimately, you know, you want your business to be resilient, right? And you don't want it to be vulnerable to sudden shocks. And so there's multiple reasons why this is justified. Number one is it's the right thing to do, but we know that's not always the reason why people open up the purses. So in addition to that, you know, it's been mandated, so there's not really a choice anymore. So firms within financial industry, they have got no choice. They're going to have to undertake climate assessments this year. And it's not just within the financial sector, right? As Maxine mentioned before, TCFD, for example, if you're a publicly listed company, then you have to disclose climate effects to your company. And that's not just in the UK, by the way, it's spreading around the world. So SEC in the US and the Fed have made the same commitments. And then you've got, like, I guess there's a whole other thing of, you know, if you get this data and you have access to it all, and you're running the scenario analysis, and, you know, that's great, you're ticking all those boxes, but you decide not to invest in terms of the things that need to happen to prevent and mitigate those future risks, then it's almost irresponsible to manage your business in that way. Effectively, what you're doing is you're breeding future risk, and you continue to run with it, knowing that at some point that the whole domino set is going to collapse, right? So there's going to be question marks, I guess, around anybody, I think, at this time that chooses to not prioritize this particular issue, because it is going to cost money. And as we talked about before, if you're in a situation where you wait too long, the cost of that transition, which, let's face it, most people have to undertake anyway, is just going to get more and more expensive and more disruptive to the business, to the operation in the future. And then aside from all of that, you've also got the fact that there's a reputational. So there's a lot of non-financial risks that I think people don't often talk about, but they do exist, right? So it just doesn't look good. There's an expectation from your suppliers. There's going to be expectations from your customers that you start to move and take this seriously. And greenwashing, I think, is the space for that is shrinking year on year as people become more educated around what's going on and what's happened in the past. So this is what I was saying, like, I've seen some good traction in terms of TCFD disclosures from being these glossy brochures and magazines with great pictures on them and some fancy buzzwords, but completely devoid of any substance, to now moving to a place where you're starting to see some real modeling behind some of the statements and the commitments that they're making in terms of future investment. So I think that's important to recognize, that there's this non-financial reputational bit and just general expectation. And then liability risk we're not really touched on, but clearly if you're a CEO of a large company that's listed, which I think most of the GSIBs in this country are, then you're in a position where, you know, your decisions will impact stock prices, right? And there's a whole range of liability risks relating to legal action and cases that are happening around the world, but firms are being negligent for one reason or another, and that's causing damage to the environment. And I think it's the time now where people have to embrace this by spirit as well as by the law. You know, you can't just keep waddling along and thinking that this problem is going to solve itself, because it won't. And I get there's a challenge for incumbent CEOs, for example. You know, you want to leave the stock prices as they are. It's not going to look particularly great that you're exposing all these risk or overvaluations in collateral, but this can't just be passed on to the next person to deal with. It's just the right thing that I think people need to do right now. And so from my perspective, I think the tide is moving in that direction. I'm seeing sentiment move. I'm seeing budgets being pushed towards exploring climate solutions and real meaningful ways to respond to the problem and start to get your arms around it. And I think Maxine would probably have experience with, sitting on CFRF, the Climate Financial Risk Forum, that there's a lot of great people, and I think it's important to mention this, that there's a lot of great people working really hard to solve these problems, because they're not easy, they're complex, and people need to talk to each other, and they need to have conversations, maybe in places that they've not explored before, and deep dive into this world, because it is huge and there's so much going on. And we're talking about climate risk, and there's broader ESG, right, that we haven't even touched on. And so I think all of these things go hand in hand. In terms of monitoring your performance, I hope that what you'll see in the longer run is that the quality of your book will improve, because if you just continue to lend irresponsibly, if you don't update your scorecards, if you don't update the way that you manage that portfolio, you're going to see that there's going to be a sudden deterioration, and it's not going to look great. So there might be some initial shocks as you rebalance your portfolio, redistribute risk, and you work things out. but I think that's fine. But eventually, I think the whole point is that you get to a place of strength, right, in the future. So that's my 2 cents on it.
Yeah, thanks ever so much, Lucky. Could I pass that across to you, John, as well, to your thoughts?
So just remind me the question again, Richard.
Yeah, so we were just going to look at, what are the regulators expecting to see from the market in terms of, how we're monitoring performance, but ultimately like how we're monitoring improvements that we're making as organizations and individuals.
Yeah, I think they're two different things. I mean, it's important for the regulators to play their role in this and to set expectations, both regulators and supervisors across all the financial services sectors. Because I think for all the people, and I'd include my organization Zurich in that, for all the financial services companies who get this and are doing a lot of the hard work that Lucky was talking about in fora like the CFRF, but in many others too, there are many, many others who are not. And if the top 20% of firms are doing something about it, if the other 80% are not, and they're hoovering up opportunities that we're leaving behind because we choose to because of the climate risk, then that doesn't solve the problem. So I think regulators do have to mandate this more. I would caveat that by saying we've got to be really careful about what kind of regulation gets put in place. And I think Lucky's touched on this and Maxine did earlier, because what we don't want to have is some kind of tick box approach to dealing with this kind of risk. We want firms to take action, and that's really, really important. And I think ultimately, the measures of success are not whether you hold capital for something that may or may not happen in 20 years' time. I think the measures of success are truly the outcomes. Yeah, that's what we've got to keep our eye on. Our firms in our portfolios, whatever they are, whether they're loan books, whether they're assets, whether they're companies we insure, are they reducing their emissions, and are they doing it fast enough to achieve the goals and avoid the consequences that David so eloquently pointed out?
Yeah, thanks ever so much, John, for going through that. I think it's, again, it sounds like a lot to take in, but it's really thought-provoking stuff. And like I say, I could listen to you speak about it for a long time, and I'm sure you could speak about it for a long, long time. But great to hear your thoughts on that. And, I guess with any of these things, we've seen it time and time again over the last 10, 20 years, with many regulations, the regulator is likely to have a big emphasis on the larger organizations first, in order to set a precedent. But, what can smaller organizations be doing? And, a lot of these new organizations in their new kind of innovative approach, are there opportunities to be had out there for these type of firms? Could I ask you that, Maxine, and perhaps followed by Justin?
Yeah, so I'll cover the point about small firms. And because this will impact all different types of firms, then small firms also need to be aware of this. And because of their nature, relatively speaking, they may actually be impacted more than larger firms, as they will have more concentration in their portfolios. So both through the physical risk, which, because their lending generally will be to people or businesses in a smaller area. So if it's exposed to physical risk, they're going to have the risk and they won't have diversified it away at all. And they're also going to be impacted by transition risk. If there's a major industry or company in their region is affected, it's not going to impact just the activity with the corporates, but it will also flow into the lending and the insurance for individuals. So small firms really need to be aware of this risk. And then we always have that problem that small firms have to try and balance their requirements with their kind of their levels of staffing. And this is where the CFRF, which Lucky mentioned, comes into play. It's the Climate Financial Risk Forum. So the PRA and the FCA were very conscious of the need for smaller firms to be able to keep up on this topic. And they set up this forum for industry, to help industry. And so it's jointly convened by the PRA and the FCA to build capacity and to share best practice. And its members are senior representative from asset managers, insurers, and banks. And last year, for example, they wrote a guide by industry for industry, which was published in the middle of last year. I think it's a really inspirational operating model with the different firms working together to help the financial system. And I'd like to see more of that in this space. And the guide has 4 chapters. One is on risk management, which looks at how to incorporate climate risk into existing building blocks of risk management. A second chapter is on scenario analysis, and it breaks that down into key steps to give firms a head start on how to approach it. A third chapter is on disclosures, and it covers the key elements of good disclosure practices about different aspects of climate risk. And then a fourth chapter, the last chapter, is on innovation, because unfortunately we need a lot more investment in this space for climate change, mitigation and adaptation. So that chapter explores emerging ways of matching finance to the investment needs and includes practical information for firms to take. And this year that work is ongoing and it's going to create more useful tools. So that really is something to look at if people haven't looked at it. So maybe on the innovation chapter, that's a good part to hand over for the discussion about opportunities.
Yeah, let me talk about opportunities a little bit. You know, I think it's very easy for this to be doom and gloom, and you know, addressing climate change is clearly a major challenge, and all of the speakers have majored on that rightly. But I think as well as risk and as well as reporting, there is reward here, and it is an opportunity, I think, for us all to build back better after the pandemic through addressing risks. So I think John talked about the physical and the transition risks as he was talking about those, and Lucky touched on them too. I think, you know, sort of taking it very sort of top down from a physical risk perspective, the more severe the events, the more we have to build more resilient infrastructure. Significant investment is needed to do that. So, you know, that's a massive opportunity potentially in building financing and insuring if we turn it on its head. And we also have the opportunity, thinking more broadly into ESG areas. There's the potential here to address significant societal issues, to address some aspects of poverty, to address inequalities. In terms of transition risk, companies and individuals have to make the transition. I'm sitting here at the moment in a grade 2 listed cottage with no double glazing. You know, I can't put it in at the moment, and that, you know, that seems slightly odd in a climate orientated environment at this point in time. And I think it's telling also in the Wreath lectures over Christmas, Mark Carney described transition risks as the greatest commercial opportunity of our time. And I think it's important for companies to get that dimension as well. You know, and clearly that's not easy, and achieving the necessary targets is going to require a lot of innovation. And a lot of political will and a lot of financing, and you know, broader financial services I think has a big role to play in that. And I think we have to recognise that reputationally, you know, following on from the banking crisis, you know, our industry isn't in a great place, and I think dealing with climate change can help us to rebuild trust quite significantly. And I think there are many potential ways of creating value in firms, and I think we touched on quite a lot of them as we've gone through, looking at the products, reviewing underwriting practices, as John touched on, allocating capital better for the long term, and thinking about longer term sustainable return in investments, you know, particularly for long term insurers. Some real potential there. In terms of the organisation's operating model, the footprint may not be as large as it is for, say, mining, but there are impacts that can be had through the supply chain. Critically, it can also impact on the motivation of teams and attract talent. You know, I was talking to somebody this morning who very much was talking about wanting to work for the sort of company in financial services that takes these things seriously. So I think to do that, I think companies need to recognise it's a very broad subject, and I think better to focus activity on what's important to you and where you can make a significant difference. For me, that's really about considering it as an embedded part of strategy, but thinking that the mindset around what parts of your business are most impacted, and recognising the need that you need to develop a long-term mindset around these things. And also recognise the complexity and interconnections between the climate change and other ESG considerations. So I think we have to be positive. but none of that kind of belies the size of the technological and social and political and financial challenges that it brings. And I think there's a great quote that I saw earlier, about a year ago now, from the Indian writer Arundhati Roy, and she was talking about the fact that the pandemic is a portal, and she talks about walking through it with dead ideas, or walking lightly, ready to imagine another world. And I think this is an example of the latter, where I think if we can bring the creativity necessary to it, that we can imagine another world. Okay, Richard.
Yeah, great. Thanks, Justin. Yeah, really, really good to hear. And I think, you know, I'll speak from my perspective from, you know, recruiting in the risk market. Is there opportunity? Well, certainly, I think a lot of the new talent that's emerging, you know, who work for fintech, you know, sectors, work for big banks, you know, a huge driver for these individuals is about going to work for, you know, a company that takes sustainability and climate risk, you know, with great importance. You know, it's a real driver for them. And I think actually the firms that do this right will see the talent wanting to work for them and will therefore make great headway in this current market. So, yeah, certainly I think there's a lot of opportunity to be had, which is great to see. So, look, going to take on to our third and final poll. And I'd just like to kind of find out people's thoughts really on, you know, does your firm understand how climate risk will affect its strategy and ultimately its risk management going forward? So that should be up on there now for you. Again, we'll leave that up there for about 30 seconds or so. Okay, wow. Okay, so I'm sure you can see. So it's, you know, it really is an even split up there. So 32% of people saying yes, you know, they do understand, but a large percentage, 47%, saying that they do not understand how this is going to impact. And I think given the emphasis that the regulator is going to have on this over the next couple of years, yeah, we'd really like to be seeing that, you know, that figure drop significantly over the next 6 to 12 months. Has anyone got any thoughts on that?
Can I just comment on that? Because I'm quite surprised that it's as higher as it is in some respects, because the data is not there yet and the frameworks haven't been quite standardized. So I'm just curious about the people that were confident that they understand the full impacts. You know, what they've done must be great progress, number one, and it's a good effort to be in that position. But I'm curious about what does that mean, and from an end-to-end perspective, you know, how all-encompassing is it? It'd be really interesting to get to grips with that. But it's good to see.
Yeah, absolutely. So look, guys, I'm very conscious of time. We've slightly overrun, you know, from where we said that we were going to be. But like I say, any questions that people do have, there will be a networking area afterwards. So I think Lucy has shared the details in the chat section that you can click into there. So I'm just having a look through to see if there's any questions that we could potentially get answered. I know the panel have been answering them as we've been going along, so they've probably done a lot of their jobs. But
away, I've seen John's been really active at that. So.
yeah, absolutely. And David, just one thing I wanted to ask, and it does touch on an earlier point actually. And you know, we've said the regulators are going to be looking at this. Obviously, it's going to be a really imperative tool that people are going to need to adapt. But you know, you mentioned earlier about the uncertainties in all of the modelling that's taken place. So given that the regulator is going to be coming into firms and monitoring, and given the fact that the models are quite uncertain, what kind of problems is that likely to throw up?
Huge problems. Vast problems. The models are so uncertain that they give different results, but that's not the point. They don't give different enough results. There's lots of evidence in our understanding of the climate system that says the models are way too constrained in what they tell us about the future. The really depressing aspect about that is that you can, well, the optimistic side is that you can put together good physical understanding arguments to get certain information out there. That's great. You can do that sometimes on local levels as well. There's a whole movement within the physical science of climate that's saying, well, maybe we shouldn't be trying to predict. We should be trying to say, explore possibilities, explore narratives and storylines. And there's lots of great work going on in there. But in terms of the predictions, the particularly probabilistic predictions, the negative side, the really worrying side, is that you can put together really good arguments to say that things are not going to be really better than our typical scenarios. There's no real way that can happen. The basis of them is conservative. In terms of the physical climate response, it can't really be much better than the lower end of what we predict, but it could be a lot worse than the upper end. There are lots of arguments, physical understanding arguments that could make it worse. Now, as far as the regulator goes, I don't know what the regulators should do, but in my mind, I've been making lots of notes. It's been a really great discussion. Thank you for hosting this. But what I have in mind is there needs to be diversity, and this has come out in a lot of the discussion. Diversity of response within the financial industry, but also diversity of use of the academic research. We shouldn't be going in expecting an answer, which we then take to apply in lots of different ways in lots of different financial sectors. You should expect a lot of different inputs as well as a lot of different responses. And how the regulator deals with that is a challenge. It's a very new challenge, but that's what we need. I also have other things I can say in conclusion, but maybe I'll leave it there for the moment.
Yeah, no, thanks for that, David. So I guess the regulators can have a pretty tough battle on their hands over the next coming months and years, but I'm sure we'll all enjoy that, and I'm sure it's got there's a lot more material to add over the coming years in terms of this topic. So look, I'd like to kind of take a moment there just to thank everyone on the panel for their involvement tonight. Like, it really has been educational, I think thought-provoking. There's so much more that I'm sure you could all talk about, and I think some of it's quite mind-blowing as well. So really great to hear all of that. I'd also like to just take a moment to thank another person on our panel, our BSL interpreter, Rachel. So thanks ever so much for being part of that. Like I say, D&I is a huge part of what we strive for as a business, and we really do appreciate you being involved in this. So thanks ever so much. So everyone, look, there's a link to the breakout rooms in the chat. The panel will be, we'll break them up in there. And like I say, if you do have any questions that you haven't had a chance to ask, or you just want to chat to people, maybe slightly more informally, and find out actually, what are these 23% of people that have got a strong climate risk structure in place doing, and just share some ideas, then we'd love to get you involved in there. So look, thanks ever so much. I will just again finish off again, but like I said, we do a series of these. We will be doing another event in the next few months, which will be focused around compliance topics. So we'd love to invite you to that, and whether that's for your team members or whoever might be interested, we'd love you to be kind of part of this ongoing story. And again, if any of you there are interested in being future panelists or getting involved in podcasts or have any topics that you'd like to discuss, then please do reach out to us. Always keen to hear. But again, thanks ever so much, panel, and I look forward to seeing you in the networking sessions.
Cheers, thank you.
Yeah, thanks ever so much, everyone.
Thanks.